Hi everyone, in this video I'm going to answer which is the better dividend stock to buy in my opinion, comparing Coca-Cola stock with Deere & Company stock. I'm going to look at their revenue, dividend yield, earnings per share, profitability, and valuation to answer the question which one is the better buy. So let's jump right in. Looking at dividend yield, Coca-Cola offers almost twice the dividend yield of Deere at 2.31% compared to 1.16%. But as you'll often hear me say, the dividend yield is not the most important criteria when I'm looking at investing in a dividend stock. I'm looking at total return, which dividend yield is one part, and I'm looking at overall return. I'm looking at the potential for increases in the dividend payment over the long term. So let's look at those metrics here. The next thing is revenue over the trailing 12 months, and this is something that is both good and bad for Deere, right? You look at how revenue has exploded since 2020. The macroeconomic factors coming out of the pandemic have worked in Deere's favor, and revenue has grown faster than typical, and it's exploded up to 60 billion in trailing 12-month revenue. Coca-Cola has also experienced a better than expected result coming out of the pandemic. Remember, Coca-Cola's products are more available in channels away from home over competitors, right? Think of when you go to restaurants. What's the drink that's most often available at restaurants? It's probably Coca-Cola, and it's exclusive. So Coca-Cola has spent decades cultivating those relationships with merchants like restaurants and movie theaters and theme parks and so on. And so now it's getting the benefit of that trend. So the next thing I wanted to highlight is the earnings per share over the trailing 12 months. And you can see they've both done well coming out of the pandemic, with Coca-Cola's earnings per share at $2.70 compared to where it was around $1.50, $1.60 in 2016, 2017. But look at Deere. Deere's earnings per share were hovering around $10, a little bit below $10 before the outbreak. And then after COVID, look at Deere's trailing 12-month earnings per share at $33.84. Now, I say this is a good and bad thing because it's good that Deere's prospects have improved and it's generating significantly higher earnings per share. However, it's also a risk because there is the chance that these earnings mean revert in the years following the pandemic as the products get purchased. Remember, there's a long replacement cycle with Deere's products. Uh, Equipment buyers don't buy these every year. They might buy them once every 10 years or so. And so with the bulk being purchased right now, is that going to create a gap for Deere over the next several years? So that's just something to keep in mind and not get ahead and just think, oh my gosh, Deere is going to generate these types of profits forever, right? No, it's a cyclical company, and right now the macroeconomic factors are strongly in its favor. But we have to be cognizant with the fact that economies move in cycles, and this is one cycle that's benefiting Deere. And so don't expect this to be the case for the next 10, 20 years. The next thing I wanted to look at is the operating profit margin over the last decade to get a better understanding of the long-term prospects and kind of work out the near-term benefits, right? So you could see Deere's near-term profit margin exploded since 2020. It exploded from a profit margin of less than 16%, around 14%, up to 23%. And that's right around 14% is what you can expect, even though cyclically it's jumped above that rate for a little while. I don't know how long it can persist generating operating profit margins north of 20%. That's not the case for Coca-Cola. It's comfortably generated operating profit margins north of 20% and moving higher at 28%. Coca-Cola's operating margins, you can see, haven't jumped the way that Deere's profit margins have in the last couple of years. Finally, I wanted to look at valuation, and Coca-Cola is trading at a forward price to earnings of near 21, while Deere is trading at a forward price to earnings of 12.6. Now, given Deere's significantly cheaper valuation, I'd be comfortable if I was a dividend investor. I would choose Deere ahead of Coca-Cola here. Understandably, I am concerned with the near term boost in earnings per share and how that might come down over the next couple of years. But the valuation, the cheaper valuation, gives me some cushion to weather that downturn in terms of earnings per share. So for those reasons, if I was to pick a dividend stock to buy today, I would pick Deere. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.